My name is Farhan. In this video, you will learn to prepare the provision for doubtful debts account. You will also learn to prepare the disposal account for an asset that uses the reducing balance method. This is question number 12, taken from 2021 Paper 1 exam. The bookkeeper of Leclerc Limited is completing the accounts for the year ended 30 April 2021. On 23rd April 2021, Leclerc Limited sold some equipment for £27,500 for which they received a check. So this amount for £27,500 is the disposal proceeds, which means this is the amount that the company sold this equipment for. This equipment had originally cost £67,500 when purchased on 1 May 2017. The bookkeeper has yet to record the disposal in the accounts. We have also been provided with some extra information. The depreciation is charged using the reducing balance method at a rate of 33.33% per annum. We also know that a full year's depreciation is charged in the year of purchase and no depreciation in the year of disposal. So let's take a look at the right-hand side of the screen where I'll be doing all the workings first, breaking down the question step by step, and then we can prepare the disposal account at the end. So what we understand by going through the question is that the financial year starts on 1 May and it ends on 30 April. The asset, the equipment that we have sold for £27,500 was purchased on 1 May 2017, and we paid £67,500 to purchase this asset on 1 May 2017, which means the first year of usage for this asset will be from 1 May 2017 until 30 April 2018. Now we want to find the depreciation. Because you're using the reducing balance method, when it comes to the first year of calculating the depreciation, you always apply the percentage that's given to you on the original cost. So what we are doing here is take the rate of 33.33% and then multiply it with the original cost of £67,500. And then we get £22,500 as the depreciation expense for the first year of usage. After that, you want to find the net book value at the end of year one. At any given point in time, if you want to find the net book value, you start with the original cost of the asset and then you subtract the total depreciation until that point in time. So the original cost is given in the question as £67,500, and the total depreciation is the depreciation expense for the first year of usage, which we have calculated to be £22,500. On that basis, the net book value is £45,000 at the end of year one. Now, if we move to year two, so year two would start on 1 May 2018 and end on 30 April 2019. And this is where the difference is with the straight line method if you're using a reducing balance method. When you move to the second years of calculation, you apply the percentage, which is 33.33% on the net book value that you had calculated at the end of the year one. And that is how you find the depreciation, by simply taking the percentage that we know and applying it on the net book value that we have calculated at the end of year one. And that's how you get the depreciation expense for year two to be £15,000. Now, if you want to find the net book value at the end of year two, we know that you can calculate it by taking the original cost and subtracting the total depreciation up to that moment or until that point in time. So there is also another way to rephrase this. If you want to find the net book value at end of year two, you can start with the net book value at end of year one and then subtract the relevant depreciation expense that you had for year two. So which is what we have done in this case. If I want to find the net book value at end of year two, I've taken the net book value that I had at end of year one, which is £45,000, and then I have subtracted £15,000, which is the depreciation expense for this year, and I get the net book value of £30,000 at end of year two. Now, this £30,000 is the basis for calculating the depreciation expense when you move to the year 3 of the usage. So the year 3 for the assets use would have started on 1 May 2019 and ended on 30 April 2020. And if you want to find the depreciation using the reducing balance method in year 3, you take the percentage of 33.33 that has been given to you in the question and multiply it with the net book value that we had got at end of year 2, which is £30,000. And then you get a total depreciation expense for year 3 to be £10,000. And if you want to find the net book value at end of year 3, you can start with the net book value that you have at end of year 2, which is £30,000, and then subtract the £10,000 for the relevant depreciation expense for year 3, and you should get £20,000 as the net book value for this asset or equipment at end of year 3. What about year 4? So year 4 for the assets used would start on 1 May 2020 and end on 23 April 2021, the day the asset was disposed. Now, the question explicitly mentions in the very last line that a full year's depreciation is charged in the year of purchase and none in the year of disposal. Given that we have figured out that year 4 is when the asset was disposed, this means that we cannot charge any depreciation based on the information of the policy that the company or the business has. So therefore, the net book value before disposal, or the value remaining for use within the asset that we have disposed, was £20,000. We understand that we have sold this asset for £27,500, which is also what we refer to as the disposal proceeds. So if we had sold the asset for £27,500 when the net book value was £20,000, this means that we had sold this asset at a profit, and the profit is calculated by subtracting the £20,000 in net book value from the disposal proceeds of £27,500, which results in a profit on disposal of £7,500. Now that we have taken care of all the calculations, let's input the numbers in the disposal account on the left-hand side. So I have also taken the format for the disposal account from somewhere in the internet, and obviously, like any T account or ledger account, you have a debit side and you have a credit side. So this is something you can memorize for simplicity purposes, but we are also going to walk through and understand how the disposal account comes into play. So you see that we have on the debit side the asset at original cost, so which is what we have done here. So asset at cost, £67,500. You can write equipment at cost. I've just written asset at cost for simplicity. And then on the credit side, you will see that we are showing the total depreciation or the accumulated depreciation or the provision for depreciation for this equipment that we have sold. So I have got a number of £47,500 here. So how did we get that? So let me remind you of something. If you remember, the original cost of the asset was £67,500 when we have purchased this on 1 May 2017. We know that the net book value right before disposal was £20,000, which means the £47,500 that we have lost in terms of value over the years of usage is what we call the total depreciation or the total provision for depreciation or the accumulated depreciation. It's the same thing. So I'm just going to write total depreciation or provision for depreciation, which is simply the difference between the cost and the net book value in this case. And that is £47,500. And this is what we are going to include here on the credit side. So if you take a look at the format, we can also see that it includes bank here. So That is why within the equipment disposal account, we have included bank on the credit side to be £27,500. Now, how does this work logically? So let's have some discussion here. You're not required to know that in depth, but you can know it. So let me show you something. So if you are selling the equipment for £27,500, how would you journalize this in the books? First of all, by selling the equipment for £27,500, the question mentions that you are receiving a check, isn't it? So when you're receiving a check, it's referring to receiving funds in the bank account. So bank is an asset, and if your assets go up because you're receiving some money, you have to debit bank. All right. So if we were to journalize that, we would be debiting bank by £27,500. Who would we have credited it? Why did we receive this £27,500 that we had debited in the bank account? So the other side that we would have credited would have been the disposal account by £27,500. And because of this journal entry, when you want to incorporate this within the T account or the ledger account, we have shown bank on the credit side of the disposal account. And this is because we understand that disposal is being credited by £27,500 because of funds that we have got in the bank. So that is one way of looking into it. Once we have all the numbers in place, I found the total on the heavier side, which was the credit side. So we added the total depreciation with the funds that we have got in the bank. So £47,500 plus £27,500, that gave us £75,000 as a total, which must be the total on the debit side so that the accounts balance out. And because the original cost is £67,500, the remaining £7,500 that fills in the deficit is what we have calculated as the profit on disposal before. Okay, so this profit on disposal of £7,500 is being shown here on the debit side, which is the amount that we need to show in the income statement under other income as the profit on disposal of £7,500. And then both sides should be even with £75,000 as the final balance. Now, another thing I would want you to show here is that you understand that we had a profit on disposal, all right? So let's have some discussion here. If you had watched my previous videos, we were talking many times about the thing that expenses are always debited when they go up. So if expenses are always debited, profit being the opposite of expenses, by definition, would always be credited, and which is the case. All income is always credited. All sales, all revenue is always credited. So all expenses, cost of goods sold are always debited. Okay, so if I was to journalize this profit and disposal, which is always credited as we understand, what we would be doing is we would be crediting profit on disposal by 7,500, and then the debit against this profit would be the disposal account itself by 7,500. We already have established before that all income is credited, and that's the reason behind why profit and disposal is credited. But you see how we have debited the disposal account? That is why when you check the T account or the ledger account for disposal, you would see that this profit amount has been shown on the debit side, which is the £7,500 that will be transferred to the income statement. So this is how it all relates with each other. What we're going to do next is prepare the provision for doubtful debts, which is the second part of this question. So Leclerc Limited maintains a provision for doubtful debts at 2% of trade receivables. So trade receivables are the credit customers of the business, and provision for doubtful debts simply means the possibility of what's the possibility of some of the credit sales that we have made that we can't receive these funds in the future from them, from the customers, from the credit customers? So is there a possibility, which in this case is 2% that they're applying, 2% of trade receivables? The balances in the ledger accounts at 30 April 2021 were as follows. So we are given the opening balance for provision for doubtful debts at 1 May 2020 to be £786. And then we are given the trade receivables at 30 April 2021 to be £33,450. We also know that there is an irrecoverable debt, which is also known as a bad debt, of £1,350 that had not yet been accounted for. Okay, so this means that out of the trade receivables balance that we have been given at 30 April 2021, which is £33,450, we haven't removed the amount that relates to a bad debt. So when we say a bad debt or an irrecoverable debt, it means a customer who has purchased inventory on credit in the past, or to whom we have sold inventory on credit in the past, has now failed to pay their dues, which means that we have to subtract this £1,350 from the trade receivables figure. So which is what we have done. So we found the net trade receivables at 30 April 2021 by starting with the gross amount that's given in the table, which is 33,451. And from there, we are subtracting the amount that we have confirmed is going to be irrecoverable or a bad debt, which is £1,350. And the net trade receivables you end up with is £32,100. Okay. Now, if you want to find the provision for doubtful debts, which is 2% of trade receivables, you just simply apply 2% on the net amount. Why the net amount again? Because 1,350 was a bad debt. So that cannot be a part of the calculation for provision for doubtful debts. So it's always the net amount when you want to calculate the provision for doubtful debts. So 2% applied on £32,100, and we get £642 as the provision for doubtful debts at 30 April 2021. Now, if you compare this to the amount that we had a year ago at 1 May 2020, which was £786, this has decreased to £642 a year later. So we understand that there is a decrease in provision for doubtful debts, and the difference, or the amount that it has decreased, is £144. Now, I want to ask you a question. Is this a good thing or a bad thing? So if there is a decrease in provision for doubtful debts, we are saying that now there is a less chance of the people who owe the business money not paying back, if that makes sense. So that's a good thing for the business, because the risk has gone down, because now you expect more people, more credit customers to pay their dues back. Right. So because that's a good thing for the business, this is what we would be adding to the other income section when you prepare the income statement. If we had an alternative scenario where the provision for doubtful debts has increased, that is what we would classify as an expense. And logically speaking, it's because the risk has gone up. In other words, the likelihood or the possibility of the credit customers not being able to make their payments have gone up. So that way it would have been a risk, and that way you would have classified it as an expense. But for this question, we know that the provision for doubtful debts has decreased, which is a good thing, and gets added to other income if you are preparing the income statement. So let's prepare the T account for provision for doubtful debts. So it's going to be pretty straightforward. So we start with the opening balance on the credit side on 1 May 2020 of £786. Always remember that provision for doubtful debts by default is a credit account. So the opening balance must be on the credit side every time. And the closing balance would therefore have to be on the debit side. So on 30 April 2021, the balance carried down of £642, the amount that we have calculated ourselves by using 2% on the net amount of £32,100. So we understand that during the year, there has been a reduction in doubtful debts by 144, which is also something that we have found within the T account as the missing balance. So 786 was the heaviest side, which is on the credit side, which must be the total on the debit side, and the deficit that we would have is 144 pounds, which is what goes to the income statement. And as we have already discussed a while ago, this is a decrease in provision for doubtful debts, which means that this is added to other income. It's a good thing for the business. Don't forget to also balance the account and bring the balance down on 1 May 2021. As you can see, I've brought forward the closing balance from 30 April 2021 to 1 May 2021 as balance brought down by 642. If you do not do this, you will lose marks in the exam. So make sure to remember to do this.